A little info about money laundering. MONEY space LAUNDERING. Money laundering. So what is money laundering? The process of creating the appearance that large amounts of money obtained from serious crimes such as drug trafficking or terrorist activity is a form of legitimate source is called money laundering. The process of making dirty money look like clean money is referred to as money laundering. Money laundering is a crucial step in the success of drug trafficking and terrorist activities. The connection between money laundering and terrorism may be a bit more complex, but it plays a crucial role in the sustainability of terrorist organizations. Most people who financially support terrorist organizations do not simply write a personal check and hand it over to a member of the terrorist group. They send the money in roundabout ways that allow them to find terrorism while maintaining anonymity. On the other hand, terrorists do not use credit cards and checks to purchase the weapons, plane tickets, and civilian assistance. They need to carry out a plot. They launder the money so that authorities cannot trace it back to them and foil their planned attack. Interrupting the laundering process can cut off funding and resources to terrorist groups. The basic money laundering process has 3 steps. First is placement. At this stage, the launderer inserts the dirty money into a legitimate financial institution. This is often in the form of cash bank deposits. This is the riskiest stage of the laundering process because large amounts of cash are pretty conspicuous and banks are required to report high-value transactions. Second is layering. Layering involves sending the money through various financial transactions to change its form and make it difficult to follow. Layering may consist of several bank-to-bank transfers, wire transfers between different accounts in different names in different countries, making deposits and withdrawals to continually vary the amount of money in the accounts, changing the money's currency, and purchasing high-value items, boats, houses, cars, and diamonds. To change the form of the money, this is the most complex step in any laundering scheme, and it's all about making original dirty money as hard to trace as possible. Third is integration. At the integration stage, the money re-enters the mainstream economy in a legitimate-looking form. It appears to come from a legal transaction. This may involve a final bank transfer into the account of a local business in which the launderer is investing in exchange for a cut of the profits. At this point, the criminal can use the money without getting caught. It is very difficult to catch a launderer during the integration stage if there is no documentation during the previous stages. Fourth is round-tripping. A new and major route through which money is laundered in India is via round-tripping. In this process, the black money generated in India is transferred to tax haven countries. Tax haven countries are those countries which have very weak corporate laws and very low tax rules. Then a company is set up in the tax haven with the black money. This black money is now shown as white money and sent back into India as foreign investment. The profits earned in India with this investment are taken back to the tax haven without paying any taxes in India. This is because such investment is exempt from taxation under double taxation avoidance agreement. This method of money laundering makes use of loopholes in the capital or stock markets, and investments are made via P notes, that is participatory notes. Journalist Paranjoy Guha Thakurta has exposed this new method of money laundering through a documentary called A Thin Dividing Line. What is the effects of money laundering? Criminals launder anywhere between $500 billion and $1 trillion worldwide every year. The global effect is staggering in social, economic, and security terms. Social effects. On the socio-cultural end of the spectrum, successfully laundering money means that criminal activity actually does pay off. This success encourages criminals to continue their illicit schemes because they get to spend the profit with no repercussions. This means more fraud, more corporate embezzling, which means more workers losing their pensions when the corporation collapses. More drugs on the streets, more drug-related crime, law enforcement resources stretched beyond their means, and a general loss of morale on the part of legitimate business people who do not break the law and do not make nearly the profits that the criminals do. Now, the economic effects. The economic effects are on a broader scale. Developing countries often bear the brunt of modern money laundering because the governments are still in the process of establishing regulations for their newly privatized financial sectors. This makes them prime target. Other major issues facing the world's economies include errors in economic policy resulting from artificially inflated financial sectors, massive influx of dirty cash into particular areas of the economy that are desirable to money launderers, create false demand, and officials act on this new demand by adjusting economic policy. When the laundering process reaches a certain point, or if law enforcement officials start to show interest, all that money suddenly disappears without any predictable economic cause, and that financial sector falls apart. Some problems on a more local scale relate to taxation and small business competition. Laundered money is usually untaxed, meaning the rest of us ultimately have to make up the loss in tax revenue. Also, legitimate small businesses cannot compete with money laundering front businesses that can afford to sell a product far cheaper because their primary purpose is to get clean money, not earn profit. They have so much cash coming in that they might even sell a product or service below cost. What is trade-based money laundering? Financial Action Task Force defines trade-based money laundering as the process of disguising the proceeds of crime and moving value through the use of trade transactions in an attempt to legitimize their illicit origins. In simpler terms, TBML is the process of transferring money through trade transactions. In practice, this can be achieved through the misrepresentation of the price, quantity, or quality of imports or export. The basic techniques of trade-based money laundering include: the first is over-invoicing and under-invoicing of goods and services. Money laundering through the over-invoicing and under-invoicing of goods and services, which is one of the oldest methods of fraudulently transferring value across borders, remains a common practice today. The key element of this technique is the misrepresentation of the price of the good or service in order to transfer additional value between the importer and the exporter. Over-invoicing of exports is one of the most common trade-based money laundering techniques used to move money. This reflects the fact that the primary focus of most customs agencies is to stop the import of contraband and ensure that appropriate import duties are collected. Second is multiple invoicing of goods and services. Another technique used to launder funds involves issuing more than one invoice for the same trade transactions. By invoicing the same good or service more than once, a money launderer or terrorist financier is able to justify multiple payments for the same shipments of goods or delivery of services. Unlike over-invoicing or under-invoicing, it should be noted that there is no need for the exporter or importer to misrepresent the price of the good or service on the commercial invoice. Third is overshipment and undershipment of goods and services. In addition to manipulating export and import prices, a money launderer can overstate or understate the quantity of goods being shipped or services being provided. In the extreme cases, an exporter may not ship any goods at all, but simply collude with an importer to ensure that all shipping and customs documents associated with this so-called phantom shipment are routinely processed. Banks and other financial institutions may unknowingly be involved in the provision of trade financing for these phantom shipments. Fourth one is falsely described goods and services. In addition to manipulating export and import prices, a money launderer can misrepresent the quality or the type of a good or service. For example, an exporter may ship a relatively inexpensive good and falsely invoice it as a more expensive item or an entirely different item. This creates a discrepancy between what appears on the shipping and customs documents and what is actually shipped. The use of false descriptions can also be used in the trade in services such as financial advice, consulting services, and market research. Generally, cases of over-invoicing or under-invoicing primarily designed to gain a tax advantage are considered customs fraud as also other manifestations as above. Generally, cases of over-invoicing or under-invoicing primarily designed to gain a tax advantage are considered customs fraud as also other manifestations as above. Prevention of Money Laundering Act. PMLA is a criminal law which came into force on July 1, 2005. Under the Act, money laundering linked to the predicate scheduled offences is liable for punishment. There are 156 offences in 28 different statutes which are scheduled offences under PMLA. Once the agency concerned with a predicate scheduled offence registers a case, Enforcement Directorate takes up investigations under PMLA to ascertain the proceeds of crime generated from the predicate offence booked by the law enforcement agency. In case of a prima facie case of generation of proceeds of crime and laundering is made out, PMLA provides for seizure and attachment of laundered properties. The action of seizure and attachment is required to be judged by the adjudicating authority under PMLA. The persons, both natural and legal entities, who are accused of the offences of money laundering linked to the scheduled offence can be prosecuted in special courts. PMLA provides for rigorous imprisonment of minimum 3 years, which can extend up to 7 years, and a fine of up to Rs 5 lakh on conviction by the court of persons who have been accused of the offence of money laundering. The conviction can extend up to 10 years. If the offence of money laundering is linked to narcotic trafficking, the property attached under PMLA can be confiscated by the adjudicating authority after the conviction by the court of the accused in the trial for scheduled offence. In terms of PMLA, the tainted proceeds, if found parked overseas, can also be restituted through mutual legal assistance after the collection of such evidence through the process of letter of request with the foreign administration. PMLA also sets out the procedure for reciprocal arrangements with contracting states for seizure, attachment, and confiscation of assets found lying overseas. India has signed the Mutual Legal Assistance Treaty with 26 countries, and by virtue of the provisions of PMLA, the center is fully armed with legal measures to get the tainted assets repatriated back to the country on conviction of persons accused of money laundering. Till the conviction, the assets traced overseas can be requested to be seized or frozen by foreign jurisdictions. Section 12 of PMLA requires financial sector entities, banking companies, financial institutions, and intermediaries to verify the identity of their clients, maintain records, and report suspicious cash transactions to FIUIND Director. FIUIND is empowered to conduct inquiry and impose sanctions against financial sector entities for non-compliance with Section 12. Financial Intelligence Unit India, FIU-IND, conducts analysis of information received under PMLA and in appropriate cases disseminates information to relevant intelligence enforcement agencies, which include Central Board of Direct Taxes, Central Board of Excise and Customs, Enforcement Directorate, Narcotics Control Bureau, Central Bureau of Investigation, intelligence agencies, and regulators of financial sector. It may be seen that under both the acts, that is FEMA and PMLA, investigation is initiated against specific persons, both natural and legal, and such action is initiated on the basis of specific information. So this was some information about money laundering.